Welcome to the Financial Advisors Want to Know podcast, sponsored by Dominion Enterprise Services. I'm Catherine Tindall, CPA and founder of Dominion. We're a tax and accounting firm focused exclusively on serving advisors for their own tax planning and filing needs as business owners. At Dominion, we work alongside advisory firm owners to bring proactive strategy, clarity, and confidence to their tax planning so they can focus on growing their firms. The focus of this show is to cover different areas that I've experienced as a tax planner, working with advisor clients in their lives, building their practices. So let's get started. Hi, everyone. Welcome to the show. This is Catherine Tindall. On today's episode, I have a special guest with me, Patricia Gentile. She's the founder of New England Tax Relief. She's both an attorney and a CPA, and she specializes in tax resolution for individuals and businesses. She's an advisory board member for the Taxpayers Defense Institute. She also has a radio show, the Patricia Gentile Show on WADK, which is on Saturdays if you're in the Rhode Island area. I think they stream it online though, right? If you're able to watch it online too. But and she's also the host of the Fighting the Good Fight with Patricia Gentile show, which we'll post links to some of her shows in the show notes. But I wanted to say welcome to the show, Patty. I'm really excited to have you on today.
This is great, Catherine. I've really been looking forward to doing this with you today. I know it's going to be great. I'm looking forward to it.
Yeah, and so for those of you listening, so I met Patty many years ago through some actual resolution work, and that's how we got connected previously. And I've always been so impressed with you, Patty, and your fearless demeanor against the IRS and just your deep expertise in this area. Because I know for a lot of the financial advisors that I talk to, the issues that we're going to be talking today around the IRS, how they work, how do notices work, how does record keeping work, is sparks a lot of fear and confusion, and there's a lot of misinformation, and it creates a lot of problems for people in a way that I think going through some of your expertise and going through some of the basics of how the IRS deals with people in a lot of these areas is going to bring some comfort and some education out there. So I really appreciate you coming on and making the time and being able to share some of your expertise with the audience.
Oh, thank you. How can we take care of your listeners?
Yeah, so I think the first place to start, and I feel like when I get into these situations with clients, the first place is there are a lot of misconceptions about what the IRS does and how they operate, and the biggest some of those misconceptions that either when you find clients where we're talking about having a tax resolution issue, so not when somebody's starting to get these scary notices, but just kind of at a really high level for people who are business owners, or just for advisors who maybe are kind of sitting ringside to their clients' tax situations somewhat. What are some of the most common misconceptions that you see for the general population about how the IRS works, and then just how some of their enforcement mechanisms work?
Right. That's a good place to start, because right off the bat, I was making a little note here that, as soon as somebody gets the envelope that has the address Internal Revenue Service, there is a gut feeling of, right, panic, anxiety, oh my God, and they're not even thinking about, did I do anything? They're not even thinking that they're all of a sudden, I'm in trouble. And then a lot of people don't even want to open the notice. Now, I'm talking to professional business owners, as well as individual taxpayers. And it's terrifying. And so they won't open the notice, possibly. They'll open the notice. Here's another misconception, is that they'll open the notice, and here's an example of a good notice. Notice CP 2000. This is a notice that the IRS is proposing to assess you additional taxes, and they give you this bottom line, and on page 1, and I think they do this on purpose to get your attention.
Yeah.
This is like a 9 to 10 page notice. But on page 1, it shows that this amount that they want you to pay them. And it can be exorbitant.
Yep.
Exorbitant. And all of a sudden you miss the fact that it's a proposed change, notice of change, because the IRS is saying on the pages afterwards, this is what you reported to us, and this is what was reported to us from an outside source, such as your Form 1099s, your Form W-2, it could be any of the tax reporting forms that you get. And they'll say, this is what was reported to us, this is what you reported, and here's the change, and then it calculates to additional tax. They'll throw interest on that, possibly penalty if it's a gross misstatement. And here's a bottom line. But as you go further into this notice, there is a response page. Mm-hmm. And this is what's very important. If the amount you see on page 1 and you just don't want to deal with it and go any further, and you decide to pay it, and you go ahead and you pay it, whether it's small, as far as you might consider small, or exorbitant, saying this is crazy, or I can't pay something on that level, I say don't pay it. Mm-hmm. And then check first.
Yes.
Meaning, look at what tax year, what form they're discussing with you, because this is not a bill. This is a proposal to change your return, and a proposal for them to assess you additional tax, interest and penalties, possible penalties. So I say stop, don't consider paying, don't panic, take a deep breath, look at that notice, and then even if your response, here's another big thing about any notice, there's always a deadline date to respond. Mm-hmm. Even if your response is, I need more time.
Yep.
Go ahead, use that deadline date, but make sure you respond. So that's a big thing about IRS notices. That CP 2000 notice is a very widely used notice. It's a matching notice. Maybe something they had in the system doesn't match with what you had on your returns. It could be a miscalculation that they've missed. Mm-hmm. And they're saying, they're not saying we've miscalculated, so excuse us. They're not saying that. Yeah. You always have the burden of proving that even they're wrong. And so that's what I strongly suggest. These notices, I remember, it was within the past, I say 10 years at most, that I believe it was Forbes did a poll, and not a poll, they did research, they did research, and they found that they published that 50% of these notices, these CP 2000 notices were, and a lot of other IRS notices were in error.
Yes.
And I don't know what the statistic is now, but at this point, what would I say? Definitely still at least 50%. No big deal. You get that opportunity to respond. Correct them. Correct your record. Bottom line is, it's a proposal, it's not a bill, and you definitely want to open the notice and definitely know what the response date is. That's very important to know.
Yeah, and I would say, in terms of my experience with clients getting those notices over my career,
Right.
I've almost never had one that's right. And I think part of it is, especially if you've got professional tax preparation. So for people
Right.
who have, a licensed professional doing your work,
Right.
unless you've been giving incomplete data, usually it's something like the IRS misapplied an estimated payment, or it's just usually some silly thing that is triggering it. And I think a lot of the times people don't realize, I know I mentioned this to you in the previous, before the show started, but this is computer systems spitting this stuff out. So,
Right.
most of the time, these kinds of notices, like you just made something in the computer system upset, or the IRS systems that they operate, the actual technological infrastructure that they have right now is probably borderline a national security threat, but it's so it's very likely you get these really low data quality kinds of notices that come out. If you have like an address change or something like that, you just want to make sure that your mail still continues to get to you when you change things. Now, the nice thing for most taxpayers is they file payroll quarterly. And so if you're filing that quarterly payroll with the new corrected address, usually that will update your address of record, but not always. So if you do change your address, you do want to change over, file a request with the IRS to change your address. And you can just go on irs.gov and get the form for that. But if you can make sure your address gets updated, because that's the primary way that they're going to communicate with you is these paper notices.
Yes. You mentioned that that is a way, the payroll tax returns that get filed quarterly, that tends to automatically change that address if you have a change of business address, really, is what we're talking about on those.
Yeah.
But the change of the individual address, since the rule is that the IRS only needs to issue their correspondence to the last known address on record, that form you're mentioning is Form 8822. And states, you go to the state website of the State Department of Revenue, and they tend to have their own change of address form. But there's also, you could do a change of business address on that form as well. If you're changing your business address and you don't do quarterly payroll taxes. I didn't want to miss mentioning that here's a form that I always see. It's very rare that I don't see this form being questioned on a CP 2000 notice, and that is the Form 1099-S for sale of real estate. That happens all the time to individuals who have sold their personal primary residence, and the IRS is looking for you to report this on a Schedule D, which a lot of your listeners as financial advisors know is for capital gain and loss transactions. And they're looking for a Schedule D in order to match up that Form 1099-S, which is strictly proceeds from the sale of a residence. Now, they don't know whether that's a primary resident or not, whether there is even a taxable gain on that, or whether the owner, the primary owner, meets those rules for exclusion of up to $250,000 to $500,000 per married couple owners on exclusion of the gain, $250 per individual, if they meet the rules for that. And so I want to mention that happens a lot. It's unfortunate because that is a very scary notice when they take the total proceeds of the sale of a residence and boom, hit you with taxes, interest, and then a gross understatement penalty. But you also said about that they're automated. Yes. And that's exactly it. This is not, these notices are coming from the computer, and they come, if you ignore the first one, there will be one following within about 6 weeks of that. And if you ignore that, there will be one following in about 5 to 6 weeks after that. And as these notices come, the threats come, trying to respond and gets a little, you can respond, but to clear this up now is a little bit more complicated, because you're losing some credibility here with them when you're not responding, and you're losing some possible rights to dispute a liability, for example, in IRS appeals. If something gets to a point that you're going to be issued now a notice of intent to lien or a notice of intent to levy, and you get a right to a collection due process hearing to dispute this. If you've ignored the prior notices that we're talking about, starting with that initial possible CP 2000, going into the, I call them the 500 series notices, 501, 504, CP 501 or CP 504, and now all of a sudden you're into these notices of intent to levy or lien, and you'll get a letter LT11 or a letter 1058, which grants you a right to a collection due process hearing. You are actually not allowed to, you're precluded, as they will use the term. You're precluded from disputing the liability that could be wrong here through the officer, the appeals officer, because you had this opportunity in these prior notices to dispute the liability. So that's a caveat right there about not ignoring any of these notices. And you don't have to be a tax expert. I mean, that's why somebody like you and me, this is why we assist clients who have tax problems, because we know the procedure. We know the IRS will give you step by step. They're number one, their rules are very clear and predictable. Mm-hmm. And then they give you these step-by-step procedures. And so these are not sudden and unexpected moves by the IRS as the progression of these notices happen because the taxpayer's not responding. That's what the problem is.
And I would say if you change your address, you definitely want to go through the process of formally updating it with the IRS in the state, because even though typically they'll update it on the payroll, they don't always. So I've had situations where payroll tax returns were getting filed to the correct address, but regular business returns were not, or they updated the business return address and then I had to call in the IRS for something, and the address they had of record was an address from like 10 years ago that never updated. So I've had it where it's broken.
Yeah.
And so making sure that you file, the correct change of address form when you move is important. Because as long as you have access to the mail, I've had situations too where a client will get an IRS notice and the notice will be dated from weeks and weeks and weeks ago, but the actual stamp on the envelope is, from recently, and they can get a notice where the due date is in a week just because the mailing system's slow. So I've had those kinds of situations as well. But as long as you've got that line of connection with the mail, like you said, it's no surprise. Like they'll send you so many notes, before they get aggressive. Like you're warned several times, and often, like you said, and I've had the situation too where it's, we get one of these CP notices and we just respond with, we've got the notice. We need more time to respond because of the receipt of the request, and then also depending on when it comes in, because if it's in the heat of tax season or whatever it is, but usually you can do some kind of initial response or call in on the helpline and talk to somebody. So I guess to kind of shift gears a little bit, to talk more kind of in the weeds for advisors, a lot of questions that I get from advisors looking at their own tax situation, from your perspective of having to work resolution work and working with the IRS in these audit situations, what should somebody who's a business owner be aware of when it comes to how they should be doing their record keeping ahead of the fact? How detailed does that need to be? And what are things that a responsible business owner can do so that if they were to get in this kind of a position with the IRS where their returns are audited and things are being questioned, they can be comfortable just knowing, I kept everything at the level I should be keeping it at, but also on the flip side, not overdoing it. I see some advisors where they overdo it. They create a lot of administrative burden on themselves that at the end of the day, the IRS wouldn't even look at it.
Yeah, great question. Great question, especially for businesses. But, as an individual taxpayer, you can understand what I'm going to say and then just apply it, the same type of methodology to your own supporting documentation for your own individual returns. But for business owners, there's a lot of records, as we know.
Yeah.
And yes, I have one of the a lot of my cases, my representation and resolution cases, are non-filed self-employed business owners. They have not filed for several years. It is not unusual for me to have to prepare at least 6 or 7 tax years of returns. Now, they have the boxes, and they have the boxes in the garage or in the cellar or all over a second bedroom that they don't use, and they need to organize them. They're like, I've got to organize this, and not so, a lot of times they'll have it organized by tax year, which is great. But every time they had a receipt for that year, every time they had a receipt for that year, it just got thrown in. So this is what I do with clients. I say, okay, that's a lot to go through, because that overwhelm is literally immobilizing.
Yes.
Yeah, absolutely immobilizing. So let's kind of cut through this a little bit. So we start with statements. Do you have a credit card? Do you have credit card statements? Do you have bank statements? Do you have records, like if you're going to take business mileage, but you don't keep as an expense, but you don't keep a log, which IRS examinations will always ask for a mileage, a travel log with your vehicle, a vehicle log. And if you don't do that, then there are ways to reconstruct that. And I'll say, do you have a calendar book that shows appointments you went to? Do you have invoices that you invoiced your clients or customers that shows you had to, if you're a contractor, you had to go to that location and do the work? And, construction's very big for audits, but realtors, they go to the site to show the home, so they have appointments of when they've met with homeowners, if they're a buyer broker or a seller broker. So you look at any records that you can stop and reconstruct where you've been and why, what was the business purpose. And, you can look up online, round trip mileage, to and from your office. Now, things that are a little tough for commingling, they're a little tough for record keeping. And commingling can be two different things that pop in mind. That you don't separate bank accounts. That you're actually writing personal expenses out of a business bank account or business expenses out of a personal bank account. Same thing with credit cards. You don't have a separate business credit card and you're using your personal credit card for business. Or you're using your business credit card for personal. So, okay, you pull these credit card statements, you pull your bank statements for the tax year, and you need to describe. You need to review those and write down what it is that was purchased or what's the income that was received. And that's how you're able to separate what was personal and what was business. IRS definitely does not like the commingling of personal and business, and that's why they want these contemporaneous records of vehicle logbooks, travel expense sheets, things like that. So it's not about all the receipts. It really isn't. It's about why did you spend what you spent? Is it a necessary and ordinary business expense? Why did you travel where you did? Mm-hmm. What did you do that was business related? So forget the receipt. If you start just from your basic records that are kept outside of your box, outside of the shoe box or the big, storage boxes, and you start with those and you see your activity of income and expenses going in and out of these credit card statements or these bank statements, and you want to refresh your memory about what you did and why. Why is this income here? Why is this expenditure? Why was it charged there? What's it for? That's what you want to know, is the why. Because I have used in audits where the record keeping is very minimal, and you can't necessarily turn around and contact the credit card company or contact the bank. It could be so far back.
Catherine here. Just wanted to say thanks for tuning into the show and hope you've been enjoying it. Since we're all at the mercy of social media algorithms, if you wouldn't mind rating the podcast on whatever platform that you listen to, I'd really appreciate it. And also, if you're looking to stay in the loop on current tax updates, what the firm is working on, and just the things that I think you as a firm owner need to be aware of when it comes to the world of tax, you can sign up for our newsletter using the link below. I only send out editions when we have really useful things to share or things that I think are important to have your attention and energy on. So let's get back to the show, and thanks again for being a listener. So for a lot of advisors, they get their income personally to them on a 1099, and that income has to be paid out to a personal bank account. What I usually recommend is for advisors who are in this situation, like certain commissions income that's not eligible to be paid into an LLC, have a separate personal bank account that is only for that activity. So it receives business income, it receives that business revenue, and then it pays expenses. Or if you have like a separate LLC bank account that you use for expenses, it only is transferring back into that LLC, so that even though it's a personal bank account, it isn't commingled activity. It's all business activity. So that's a common issue specific to advisors that I run into.
That's perfect. That's exactly what they should be doing, because they actually have the regulation that states how they have to receive their commission.
Yeah.
And so that just supports why there is that personal bank account. Then at that point they'll transfer into the business once they receive that personally? Is that how that works?
Yeah, so usually they'll transfer it into the business. Yeah, what's a little bit tricky is that there is an old tax court case from 2017 with an LPL advisor where basically they disallowed his S corporation. It's a longer conversation than probably we should have today, but right. Basically the long story short is, at least on the front end, make sure that you're using separate accounts for that, and if you can have agreements with your LLC. There's we have a separate episode that talks about S corporation issues for advisors that I recommend people check out, where I talk about this in detail. But I guess one other question when it comes to the record keeping is, a very common question that I'll get from advisors is, you run into some of these expenses that have kind of a quasi-personal flair to them. And so, a lot of times advisors will be asking me questions like, well, what really counts when it comes to vehicle mileage deduction, home office, meals, travel? Where is that line between these kinds of expenses that have, kind of it could be a personal or it could be a business expense. Like, where is the line? So could you speak a little bit to that and, in your experience, like how the IRS looks at, where the line is, how aggressive they are with challenging some of these deductions, those kinds of things?
That's a good question. The line is whether, for example, the travel, if you bring a spouse to a conference with you, anything to do with the spouse, the hotel, the airfare costs, the hotel costs, the meals, etc., it's just going to be 50%. You can't include the total 100% because you brought your spouse. So that's a personal aspect there. Of course, any travel, vehicle, or hotel, air, even cab or Uber, there has to be a business purpose. That's the line.
I think maybe just one last kind of general topic for us to hit. So it's not uncommon that people will owe more taxes than they can afford to pay at any one time. I encounter this more specifically. This tends to happen to advisors sometimes where their tax professional maybe was giving them safe harbor payments that were based on a prior year's activity, which was way less than the actual current year activities. So now you've got a big tax balance due that you weren't ready for. How does the IRS work around when you genuinely have just fallen behind with owing taxes? And then I think maybe one other distinction to bring up is, do they look at these differently depending on what kind of tax it is? So basically payroll taxes versus, say, income taxes. What are the things maybe that people who are falling behind on their taxes, or especially for advisors who are working with clients where maybe they've fallen behind on making tax payments? What should people know about what you can do if you can't afford tax payments, or you need more time? Like, how does that process work?
Yeah, great question. And I definitely want to separate the types of tax. I want to just strictly say about payroll, especially trust fund portion of payroll taxes, which is what the employer withheld from the employee. That's the employee tax, and the employer has been entrusted to collect that and remit it to the IRS, to the Social Security Administration, and any state Department of Revenue. That's the employee's portion, and that's why they call them the trust fund taxes. Those will follow you right to a personal level if you do not work out a repayment plan with the IRS or the State Department of Revenue to repay those trust fund taxes. They will follow you on a personal level. It won't just stay with the business level, the employer. Mm-hmm. If they find that they want to deem you a responsible person for making the decision not to pay these taxes, right, when they came due, and you're the decision maker, and therefore they'll assess you as well, and they call that the trust fund recovery penalty. They cannot call it the employer tax. Mm-hmm. Because only one person can have the tax, be responsible for the tax. That's the employer, i.e. the business. But when they want to hit you on the personal level as a responsible person as well, they will call it the trust fund recovery penalty. So that's very big. You jump on that very quickly to get yes. A payment agreement. My rule with resolving back taxes, whether it's business or individual income taxes, is you stay current. You use current income to pay current taxes. You have to be in current compliance. You have to have filings up to date and current, and you have to have current payments, or else when you are trying to negotiate any type of resolution plan program. Whether it's installment agreement plans, offering compromise, maybe a hardship consideration as they call currently not collectible, which is a hardship consideration. Either the IRS or State Department of Revenue technically cannot work that with you unless you're in current compliance. They want that bleeding stopped. They want that behavioral stopped. So that's number one, be current and stay current. When it comes to the individual income taxes, and I'll go back to you mentioning about the separate bank accounts for the advisors who receive their commission under their personal individual license, have a separate bank account for your estimated income taxes as well.
Yeah.
So have a separate bank account strictly to throw. I don't care if you throw it on a weekly basis, a little bit weekly, so that it's not a big chunk when you have to pay your quarterly estimated income tax, federal and or state. Now, going back to back taxes where people have underpaid or missed paying quarterly estimates, and here they are. Do not play catch up with your current income. Stay current, always stay current, and try and qualify to resolve those back taxes with any of the programs that are available to you that the IRS and or your State Department of Revenue offers to resolve back taxes. And really that's my recommendation about trying to be on top of it all. Current year projections, current year estimates, staying current, and then having to deal with back tax issues, balances owed. Even penalty abatement, maybe you have reasonable cause or causes that during that time period, what happened a little bit before, a little bit after that tax year, or the quarters, if it's payroll, that caused late filing penalties, that caused you late payment, not to even be able to pay. And you can have reasonable cause or causes, and you can request penalty abatement, and that'll reduce it down what you owe. The penalties plus the interest. There's penalty interest. There's interest calculated on penalties. So reducing it by penalty and interest, and that makes that more reasonable maybe for you to be able to be on an installment agreement plan, a monthly installment plan.
Yeah, I think that's great.
Yeah, those are my recommendations. Plus to talk to people like you and me. That's always my recommendation.
Well, I think, kind of the big takeaway for most people, the big idea there is you have to have an infrastructure around this, right? Like you have to have a system around it. For most of the clients that we work with, like we have a process that we're going through during the year to be ready for this, because if you're just not paying attention to it, it sneaks up on you. Or I've had the opposite where people overpay and then they're getting these big refunds, and it's like, well, you could have used that money in the business, and then if you had used that money in the business, you would have had a smaller tax liability too. So I think it's more about just being proactive with this, because even though we play the game on a year where it's okay, well, what's your taxable income going to be as of 12/31? This time of year, I'm having conversations with our clients about what's their tax bill is going to be for April 15th next year, because, we have to pace out the timing. And then also, we don't want to prepay the IRS anything, but you also don't want to undersave. So you kind of need to have both of those going at the same time so that okay, I'm paying in, so I'm not going to have penalties, but I'm not prepaying my liabilities sooner than they're due. Where if there's a change in the business or we overestimated our performance or whatever it is, you haven't lockboxed money away that really you should have just been saving in a separate tax escrow. So all of that's excellent. So I appreciate the, for those of you listening, this is a quite a bit longer episode than we typically do, but I wanted to do, a deep dive on this because there is a lot of confusion around, how these systems work and, kind of what you should be aware of at a basics level of how the IRS works, some of these bigger questions that I commonly encounter. So for people people who are interested, where's the best place to get in touch with you, Patty, and where can they find you?
Go to my website, newenglandtaxrelief.com, all one word, and you can schedule a complimentary telephone consultation with me if you want to speak with me about any questions you have. Also on my website, I have a podcast page where you can see all my podcasts chronologically and any other interviews I've done with other hosts. And I appreciate you having me on. Catherine, this was great. You and I could talk shop for hours.
Well, we have in the past.
Yeah.
So for those of you listening, we'll post in the show notes where you can get in touch with Patty. I really appreciate you coming on and, the willingness to have this conversation. I think it's extremely valuable for the audience. Now, before we go, was there any final thoughts or things that we maybe didn't cover that you want to leave the listeners with?
I just want to say, open the letter or the notice.
Yes. No head in the sand. Don't do it. It's tempting.
Right?
Don't do it. Yeah.
Don't go it alone.
Yeah.
And don't wait.
Yeah.
Really. That's my best advice.
Yeah, that's excellent. Well, thanks again, Patty. And for those of you listening, if there are specific parts of the episode that you found particularly intriguing or thoughts, I'm always interested in hearing feedback, and something for you, for those of you who've made it this far. If you're interested, we had a little bit discussion earlier around, deductibility of meals and entertainment and things like that. If you're interested, we do have a free resource that we've given out in the past that goes through some of the categories, and there were some changes in 2026 around meal deductibility. So if you're interested in that, we have a sample memo that actually goes through the different categories and their deductibility. So if you're interested in that, just send me a DM. I'll send you a copy of it. And then for those of you listening, if you're not on the newsletter that we have, that's a resource that we gave out on a recent newsletter. And then in upcoming newsletters to come, when we create these kind of general use resources that we share with our own clients, you can be on the newsletter and get access to them as well. So for those of you listening, you can check those links out in the show notes as well. But thank you, everybody, for tuning in. And thanks again, Patty, for being on the show. I appreciate it.
My pleasure. Thank you.
Thanks for listening to the Financial Advisors Want to Know podcast, again, sponsored by Dominion Enterprise Services. If you found this episode valuable, I would love to personally hear from you. Connect with me on LinkedIn and send me a message. I'm always interested in your feedback, future episode ideas, or questions you'd like to see covered in a future episode of the show. And be sure to subscribe to our monthly tax update newsletter, where we share timely tax insights and planning considerations specifically crafted for advisory firm owners and what we share to our own clients. We'll see you next time.